Hi, I'm Jimmy. In this video, we're going to look at some of the most common mistakes that investors make and that we might be making right now. So I've had different investors come to me recently as the stock market's been tumbling. As we can see here, this is a chart of the Dow Jones Industrial Average. It's down 9% year to date. And I've had different investors mention to me, or different comments that I've seen on YouTube, where people are like, hey, I'm looking at my portfolio, I'm seeing a whole bunch of red. Should I sell? What do I do here? Do I buy more? It can be a bit confusing. So that's what we're going to address in this video. So as we can see, clearly the Dow is down about 9% year to date. The S&P 500 is down about 11%, and the NASDAQ is down the most, down at about 15% from the start of the year. So these are big numbers overall. Now, to illustrate what I think is the solution to one of the biggest problems that investors face and one of the most common mistakes investors make, to illustrate that, I'm going to use my personal portfolio. So this is my personal investment portfolio. We can see first off that I got Apple off here to the side, and that is because Apple, I was actually gifted some shares of Apple from, not gifted, but you know how if you click on, like I have a Robinhood link in a lot of my videos. If you click on that link, I get a share of stock, you get a share of stock. By coincidence, I've done that, a few people have clicked on the links, and I happen to get 2 shares of Apple 2 different times, but that's why I have Apple, because it's not really a big piece of the portfolio. It's just 2 shares, but it is there, so I want to bring it up. But these are the actual shares. These are the actual companies that I have made decisions to purchase. And if we are curious, these are the prices that I paid for each of these stocks. And as of the close of business just recently, this was yesterday's close. Well, yesterday's close, we can see that some of the stocks are doing pretty well. Some of them are down a bit. Disney, I'm doing fairly well. Intel, I'm about flat. Lockheed Martin, I'm doing fairly well. Alibaba, I'm down. The green is where it's currently at. Alibaba, I'm down a bit. AT&T, down slightly. Activision, I'm up pretty well. Facebook, down a little bit. That's my most recent purchase. And this brings me to the reason I wanted to make this video. So in a recent live stream that we're doing, we do private live streams for our investing community. And in that live stream, somebody said, I started investing about 1.5 years ago, and I'm looking at my portfolio and it's all red. What do I do? And that can be, I understand, that's a very common fear, I think. I get a lot of family members telling me that, hey, I'm looking at my portfolio, everything's down. I'm just selling, like I can't take this. And I actually have the underlying reason why. I'm not talking the stock price is low, the stock price hit my entry point. That's the mechanic. That's actually part of step 2. Step 1 is understand the fundamental reason why. For example, Intel. I like Intel's business. I like the semiconductor business. I also like AMD. I also like NVIDIA. Intel, I bought Intel when there was really bad news. They were having delays in their 10 nanometer chips. And I looked at the company, I looked at their potential, and I said, you know what? Fundamentally, I like this business. More and more things. My refrigerator has a chip in it. I mean, everything's getting a chip in it. I think that this industry will continue to grow, and I really like that business. And I think Intel has the size to grow. Plus, they were priced better than AMD or NVIDIA at the time. I thought the other two were overvalued. So that's why I jumped in and bought it. Now, the key here is that we know the fundamental reason why we're buying the stock. I believe for Intel that they can start innovating their chips and grow their business again. If they said, you know what, if they came out tomorrow and said, we're reducing the amount of money we're spending in R&D, we're happy with how good our chips are, we're really not pushing to get any better, immediately I'm selling. What's the stock price? I don't care, I'm selling. Because they just violated the reason I bought the stock. And I think that's the key. The key is that we fundamentally understand the business. If we look at a company like AT&T, they came out with some news that made me want to buy them. First, they're spinning off the Warner Media business, and I want a piece of that deal. They're going to combine the Warner Media business with their with Discovery, which is already publicly traded. And okay, I'd like a piece of that because I think that potential, HBO and all of that, has growth potential. More importantly, AT&T as a company, I like their core business. I like AT&T's core business. I just don't like all the add-ons that they made. So they spun off DirecTV. They're getting rid of Warner Media. They're starting to go back to their core business. If tomorrow they started violating that and said, you know what, we're going out to acquire some random business to try to grow, Well, to me, they're violating the fundamental reason I bought this stock. That being said, when we're sitting there, we're watching the S&P 500 down, call it 10, 11% year to date, and then we're looking at our portfolio, and let's say the fundamentals of our portfolio haven't changed. Well, what's the difference if our stock is down? You know, I bought AT&T. If AT&T, right now it's trading at $23.23 as of yesterday's close. What if that stock dropped down to $10? Well, if there's nothing that has fundamentally changed about the business, why would I sell? In fact, isn't that a better reason isn't that a bigger reason to buy the stock? And I think one of the biggest mistakes that investors make is when the stock begins to go against them, the stock starts to head lower, people panic and sell, which is exactly the opposite. Warren Buffett says to be greedy when others are fearful and fearful when others are greedy. The very concept of that implies that if everybody is saying that the stock market should be lower and everybody starts selling and driving it lower, isn't that the right time to buy? If everybody's saying it's going to go higher and everybody's jumping in to buy the stock, is that the time to sell? You know, if we're listening to Buffett, same thing is true. I don't know how many people have told me that instead of Intel, I should be in AMD. And I like AMD's business. I'm not going to deny that I like their business, but AMD, everybody was saying that they liked AMD. AMD was trading at a much higher valuation than Intel was. So why would I want to buy where everybody else is going? I want to be in the spot that people are saying, don't do it. I bought Activision. Activision, I'm up fairly well because Microsoft announced that they're going to buy Activision. But I only bought Activision. I bought it before the Microsoft announcement, but I only bought them because there was bad news about the company. The company got driven lower, and everybody was saying how much they disliked it. I thought that they could turn that around. They could fundamentally shift that business and start treating their employees well. And if they did that, then the business would come roaring back. Well, you jump in and buy it, and then I happen to get benefited quickly because Microsoft said, all right, we'll change the company, and they acquired it. Plus, I read recently that Buffett or Berkshire Hathaway actually bought Activision right around the same time I did as well, so I was excited about that. This brings us to the second point. And the second point is that we don't overpay for any stock. So, to help address that, you know, Intel, for example, it was up to in the mid 60s. It's down like 30% off of its high. It's not bothering me, despite the fact that it's pulled back, because I bought it at what I deemed to be a very good price. So I'm happy to sit here and wait for the long run. By the way, all these positions for me are intended to be long-term investments. So step one is make sure we know the reason why we bought the stock, the fundamental reason for the business. If we don't, up or down, it might make sense to get out of that position. The other thing is to make sure we buy the stock at a good price. Now, one of the things that we're doing to buy a stock at a good price is we've created this discounted cash flow calculator. Now, we're in the middle of building a website where people can use this to come up with a fair value for their stocks. So, for example, as we can see here, we got a stock like Alibaba, and the current price, 108.93, we have the fair value using a 7.5% required rate of return well above that. You know, even if we wanted to use 10%, it's still well above that. It's still well above the current price. Now, I actually did a video called 8 Steps to Analyze the Stock, where you go through, I lay out the process for truly understanding the business to see if you fundamentally like where they're going. If you do, then you come up with, okay, where do I want to buy the stock? For example, on my bucket list of companies to buy is Apple. I really like Apple, but the current stock price is at about 162. I've got the fair value at about 145. So I need that stock to drop just a bit more. So I sit here and I wait for the stock to drop. Now, it's not like Apple stock doesn't go up and down. Apple stock is also off of its highs. So if it does get to the $145 range, I'd love to jump in and buy this stock. And again, hold it for the long run. And this is so important because if you know why you bought it and if you're confident that you bought it at a good price, then when we go back to my portfolio, well, when a stock like Facebook, which I thought I bought at a good price at 224, it's down at 207 now. Well, a stock like that, I might consider jumping in and buying more because if I liked it at 224, shouldn't I, in theory, still like it at 207? So I've considered for both Alibaba, which I already averaged down, and Facebook, picking up a few more shares and averaging my cost down a bit, because why wouldn't I like this company once it goes on sale? So if you are wondering, if you're worried about your stocks being in red, ask yourself the question, do I still like the fundamentals of the business? Forget the stock price. You know, if Disney's stock price got cut in half tomorrow, I would buy it. I like the fundamentals of their business. If you like the fundamentals, don't look for confirmation from the stock market that you're right or wrong. You know, Lockheed Martin being up in the short term doesn't necessarily mean I was right. The question will be, over the next few years, does the fundamentals of the business go in the direction that we think that they're going to go in? That I think that that's why I bought it. If you bought a stock and you think the fundamentals are going to go in a certain direction, do they go there? And then the second part is, of course, make sure you buy the stock at a good price. So if you'd like to get access to this investment calculator that, again, will be up and running by the end of the second quarter, and in the meantime, you'll get access to our private investing community. I will leave a link in the description below for how to sign up. And if you do sign up today, we are locking in the price for you forever. The price that you sign up today, it will never, ever go up on you. So again, I will leave a link in the description below. I got a link right here. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Try to stay sane out there as the market's sort of sorting through its issues. Thank you, and I'll see you in the next video.